Hello everyone and welcome to yet another meeting with the expert with our partner Global BD Trading. The topic of today's meeting is very interesting. Randomness versus trading, or versus speculation, or versus investing. So this will be something a little bit different than we talk about just recently, because I would like to present to you some kind of a conception which is widely popularized by the Mark Douglas basically and his teachings, his coaching and his training. So let's start with our new meeting regarding the randomness versus trading. Of course, the second slide is the disclaimer, and this is the agenda of today's meeting. Randomness, gambling, and trading. Are there any differences between those? Is trading a gambling? Plenty of people is thinking that it is. What is the truth? What is the current point of view regarding the trading and gambling? Now we are going to talk about risk in trading, and at the end of this short presentation I will provide you correct speculation process according to the Mark Douglas. So let's just dig in a little bit deeper to the core of our meeting. Is there any difference between gambling, trading, speculation, as you can say, or investing? So just think about it for a minute, so you can just maybe find this difference. Because if I said if there is any difference, so in my opinion there must be one. So right now what I would like to hear from you is that there is a difference, and the difference is this and this and this. All right, so basically what I mean by showing you the screen is that trading is not investing, speculation is not gambling, gambling is not trading, and gambling is not investing. Okay, those are three different activities, and there's a peculiar difference between all three of them. All right, so what's the difference? Maybe the first thing is, what's the difference between gambling and trading or speculation? Because plenty of people think that if you trade on the stock market, you are basically a gambler. You're gambling your money. Well, that's not entirely true. The difference between gambling and trading is rather sophisticated, and it's not that easy to spot on at the first glance. Gambling means that the outcome of any particular behavior of the gambler, for example, he's playing roulette, or he's tossing a coin, betting that there's going to be head or tails. This kind of a behavior is a 100% example of the gambling behavior. So what I mean is that you got only 50% chance that the outcome of this kind of a behavior will be basically in your favor. So it's either head or tail, 50-50. It's either black or red, 50-50. Okay, it's either up or down. And this is what most people think, that when you are trading, you are basically gambling for the stock or currency or cryptocurrency or whatever, that it's going to go up or down. And that's the only thing that you can say that gambling and trading have in common. But there's something completely different between gambling and trading. The first thing is that in gambling you got 50% of chances to win, basically, and if you trade, you need a trading edge. Otherwise, trading is gambling. So if you don't have a trading edge, if you don't have your edge and you don't play your edge, basically you are not giving the odds of a possible profit or possible wins basically over the time. You are not leaning them to your side basically. You don't have to have a much of this percentage on your side. It might be 51%, it might be 55%, it might be 60%. Nonetheless, your trading edge should give you a little bit of the edge, of advance, of a kind of a different point of view, maybe different behavior, maybe different money management, whatever, that should play the odds in your favor. Right? The gambling has always an outcome, up or down, black or red, heads or tails. So that's the first difference. Okay. The second difference is that if you want to, you can go right now to the casino and gamble, basically, right? You don't need any research, you don't need any knowledge, basically. You don't need to develop yourself, you don't need to do anything. You just need to have money in your pocket in order to go and gamble, play some roulette or whatever. The difference is that if you want to speculate, if you want to trade, you need to develop yourself from the beginner to the professional successful trader. Well, you can say that in a gambling that's the same way. Yes, it might be the same way. Nonetheless, the gambler basically is much more addictive. The gambler is much more addicted to the behavior of gambling, of betting basically, and sooner or later gambler will gamble only to feel the rush. It doesn't matter what the outcome is. That's exactly the opposite of a trader. And in order for the trader to develop over time, the trader needs to go through the trader's development path. This kind of a concept has been introduced in the very first video of the series. So if you don't know what I'm talking about, just go back and watch it, basically. So that's a major difference between gambling and trading speculation. There is the other difference between investing and trading or speculating, because plenty of people are saying, oh, trading is the same what investing, or I'm investing my money in this stock or this stock. Yes, you are apparently right in that situation. Nonetheless, the major difference between investing and trading is that investing creates something else than just the profit. Investing gives people job. It gives them a security number, social security number. It gives the society something more than just profits from spending money on some kind of investment, right? Trading is the activity which is basically done just for the purpose of making profits. Traders doesn't care about anybody else than the deposits, and the money on the deposit, and the broker which is holding this money on the account. So basically, maybe they care about the brokers, but nothing else is actually going to be produced, or nothing else is going to be explored during the process of trading or during the speculation process. All right. So there is no other added value in the process of trading. The trading is a sole process for itself. This is why you do it, just for profit, just to trade. You don't care about creating money. You don't care about opening like a business, bar, or bowling area, whatever. Basically, so people can come, can work, you pay them salaries or wage or whatever. You don't care about this. What you want to do is to trade on the financial markets for the sole benefits of profit, and to be a successful trader. So that's the difference between trading and investing, basically. And the last one, just like a curiosity here. The difference is like investing is being seen by the society in a kind of a positive way. because if you are investor, that means you, as I said, you're creating possible jobs for people. For example, you can create some other outcome, like if you build a hospital or something like this, you are saving people's life and making people wealthy or something like that, right? So that's even more than just giving people job. So the social outcome from this activity is very positive. Traders, speculators, people don't like this kind of a people. The other people don't like traders. Basically, if you tell people that you trade something, they say, "Oh, you are a gambler and you basically a thief, or some kind of a person which reputation, whose reputation is questionable." Basically, right? So that's the social perceiving social attributes that are being very, very, very common among the people in the general Western society, and there's basically not much you can do about it. Of course, you can try, you can spend your money doing the charity or something like that. Nonetheless, there's still a long road to change it. So nevertheless, this is the difference. There's a difference between gambling, trading, and investing, and what I'm trying to tell you is only one thing here has a future. One activity here has a future, and this is the trading or speculating activity. Nonetheless, there is a difference between trading and speculation, but that's so much details in that between those activities that I don't want to come on this right now. Okay, so we will treat trading and speculation on the financial markets as the same activity, right? So if you want to be a successful trader, you cannot gamble, and you basically, maybe when you will be more wealthy, you can invest, of course, money in something else, which is completely different business area than trading speculation. Nonetheless, there is quite of a difference between trading and gambling and investing. That's my point. So that was the first question, if there's any difference between gambling and trading. And there is the second question. Here comes the second question. You can of course answer for yourself. What's more probable? You toss a coin 10 times. Head is H, tail is T. Which one of this outcome is more probable, in your opinion? Just take a look at this. You got three different rows of coin tossing here, and plenty of people will say that the first on the left, is much more probable than the other ones, than any of the other ones. The second one is kind of it might happen, but the third one, the one on the right hand side, is completely, it's like now almost no one will say, oh, that's not possible to do, to happen, basically, right? And of course, all of them are wrong, because every single of this outcome of a coin toss is basically equal, right? The probability of any of the series is equal, right? Basic law of the statistics. But our point of view as a human is completely different, and that's why there is some misunderstanding between gambling, between trading, and between the investing, because people do not cope really well with the probability, and I will show you why you should basically take into the account the impact of the probability on your trading. We are going to talk about the signal generating by the market. So what I want you to understand is that the market will be generating signals upon which you are going to trade. Okay? So what is that process of signal generating? For example, you have here a very famous pattern, the price pattern called head and shoulders. And you know that the head and shoulders have a left shoulder, a right shoulder, and if you connect the correct points on the chart, you will have a neckline, and you should trade to the downside, the breakout of the neckline, and then eventually you should even try to trade the test of the neckline from below. All right, so this has been basically your signal. The signal is breakout of the neckline after the head and shoulders pattern is being seen on this on the chart, right? Nonetheless, plenty of people say sometimes it works, sometimes it doesn't work, right? So that's the difference. Sometimes the head and shoulders works perfectly and traders make money, but sometimes it doesn't. So why is that? Well, the signal doesn't always work because the market has a random distribution of winning and losing signals over the time. So what I'm trying to tell you is that the head and shoulders you see on a daily time frame chart of the euro dollar is something that you and few of other technically inclined traders are seeing. Okay, it doesn't mean that the other traders will be trading in line with you, basically in what you are seeing on this time frame, because they might have completely different approach to the technical analysis. They might not use it at all. They might be using different indicators, different patterns. That might be waiting for completely different signal to occur, and they don't care about the head and shoulders. Their time frame might be different. Their risk management might be different, or they are having, much more different point of view on what's going on the market than you. Okay, so this is why sometimes head and shoulders will work on the market, and sometimes it not, because in order for it to work, the majority of the market participants must play along with this pattern on the particular time frame. All right, if they don't, that means, well, head and shoulders, so what? We are not paying attention. We are waiting for something else. We are looking for something else. We are not making the head and shoulders as our signal, basically, and this is why the head and shoulders might not work. So the situation here is like, first time it occurred, it works. Second time it works. Third time it works. So you are being certain this will work over the time, maybe even to the end of the world, or to the end of the market, or to the end of your life, basically. In the fourth time, you see the head and shoulders pattern, it doesn't work. So you are questioning everything. Oh, why it doesn't work? Technical analysis doesn't work. What is going on? It used to work before, now it doesn't work. What's happened? Why this is, I have to quit trading and stuff like this. Well, that's not a good decision, basically, because as I said, this time the market, the majority, the stronger part of the market, basically, didn't play along with what you would like to see on the chart that would give you a signal to trade. Yeah, that's why it doesn't work sometimes. Toss a coin 10 times. Toss a coin 10 times with 70% success rate. So what you will receive, basically, you will have a very, very, very nice trading system. 7 times out of 10 times you will be right. What you have to do is to make more money when you are right than lose money when you are wrong. Which means, for example, no over trading, no keeping the losing trades, closing the losing trades on stop loss, and so on and so on. If there's a signal on the market, you never know who will play it. What kind of a group or individuals of companies that are participators of this market will play with it, right? So you don't know when this head, if the head is the winning side of the coin, right? You will never know when this head will fall out, basically. Even if you toss a coin 10 times, right? You don't know exactly when the heads are going to go. If you see a signal on the market based on the, for example, head and shoulders pattern on a daily time frame chart of some stock, cryptocurrency, euro, dollar, whatever, you don't know whether this time the market will play along with you, and if you open the short position on the neckline breakout, will it be profitable? Nonetheless, there is a profound conclusion from this situation. Let me just switch to another slide. Basically, when you're trading, you're thinking that if the signal worked in the past and it doesn't work now, why it happens? You try to figure it out, and then of course negative emotions comes in. It didn't work. I'm frustrated. I'm angry. Market took my money. You are being frustrated because you expected this signal to work every time, which is wrong. You expected a profit this time. As I said, let's stick to the example. The fourth time the head and shoulders didn't work. 3 times it worked very well. 4th time it didn't work. You expected it to work again, but it didn't. Why? Because you expected it to work. Basically, your expectations are creating the frustration and your belief. Oh, this is a good pattern. It should work because it worked in the past. Okay, I'm gonna make big money right now. It worked 3 times in the past. Now it's gonna work again. I believe in that. I expect that. I want that. Here's my money. Take it. I bet even double this time. Ha ha ha. I have found very good pattern. The price will go in my direction. Let's short it. Well, the price change in the market is the result of the individual investors, individual companies, and beliefs or point of view that's much more applicable here, right? The point of view that the price will go up or the price will go down. Okay, this is how the signal is generated by the market participants, which is of course you can say the market participants are the market, right? So everyone on the market expects this market to basically work, which is why it doesn't work. You are frustrated, you are angry, you want to quit trading, and a whole of a wave of the bad emotions flow into you because market took your money, you are on the loss, and it was so good, it worked before. And that's another thing that you try again or not when you see head and shoulders pattern on a daily time frame chart of whatever you want to trade, right? You will try it or not. Answer it for yourself. Generally, the signal generating scheme on the market looks like this. There is a price pattern you want to play. You want to trade the price pattern. Doesn't matter if this is a head and shoulders. That's just an example. Doesn't actually matter which one. Double top, MACD cross, this wave, third wave, fourth wave, I don't know, fifth wave, pin bar, bearish engulfing, whatever it is. There is something you recognize then that tells you start trading. This is your signal, right? This signal has a random distribution. Okay? It might work this time, it might not. It might work 3 times in a row and 7 times in a row might not be working, but you don't want to believe it. You don't want to see it, basically, because it seems impossible for you. But the statistics is, washed from the emotions, basically. It's just kind of a way of counting things, basically. So there's a random distribution. This signal might work, might not. Okay, but if it happens, you know that, oh, there are some players, there are some traders, there are some investors, there are some speculators who see this as I see. The question is, do we have enough capital? Do we have enough power to trade with the market? Right? Are we the winning side or not? If this is, they say, fake signal, the market is not doing what it's supposed to do, The frustration, disappointment, anger, powerlessness, uncertainty, and depression even might be the result of this market behavior. But don't be afraid. We got mental pain mechanisms developed in our mindset, in our psyche, that helps us to avoid unwanted and negative consequences of the random events. Don't worry about it. We will talk about it next time, maybe. All right. So this is basically the signal generating pattern. Let me just show it to you once again. Here comes the price. There goes the signal. There's a random distribution. You don't know if it's going to work or not, but you expect it to work because it worked before. If it doesn't, frustration, disappointment, anger leads to you, and you have to deal with this. So you do something basically in your mind, or you do it by making some kind of a behavioral activities as well, to get rid of these negative emotions and to get rid of this mental, basically, let me call it pain for the lack of any better word. All right. Now, have you ever heard about slot machine paradox in signal generating activities? What I mean here is the profound difference between gambling and trading. And just take a look at this. You know this one, right? It's a slot machine. The slot machine pays you money if the correct pattern will show up, right? So what you do, first you risk, then the pattern occurs. You go to the slot machine, put your money in, right? And then you spin the wheel, and maybe you will get the pattern that will make you more money than you put in. So first you risk, you put the money to the machine, then you wait for the pattern to occur. It will or will not occur, okay? In trading, it's directly opposite. First, the pattern will come to the market. First, the pattern will be generated by the market, okay? Then you risk certain amount of money on this pattern. So you bet, basically, you can say you risk certain amount of money, and you wait for the market to tell you, is the tail or head? One of the side of the coin will win. Okay. So that's the difference between gambling in slot machine and trading. Okay, completely different behavior is presented here when you trade and when you gamble. If you don't do it, sooner or later you are accident waiting to happen, basically. So what is the correct speculation or trading process as it was preached by the Mark Douglas, the guy who wrote Trading in the Zone and the other very nice and informative books about trading, guy with over 40 years of experience in trading. So let me just present it to you right now. The first thing is you need to have a trading edge. You need to have a strategy, a risk to reward mechanisms and rules, and you need to work on yourself. Your psychology must be completely different than the psychology of the random bypasser, basically on the sidewalk. Okay, you need to have trading edge. If you don't have a trading edge, if you cannot explain to me in 3 words what is your edge over the market, you are a gambler. And as we know, at the end, casino always wins. Okay, so get trading edge, because the odds of the trading edge must be in your favor, right? They cannot be against you. And you must trade every signal your strategy, your edge is giving you, because you don't know the winning head and tails random sequence. Okay, remember the 3 sequences I showed you on the beginning? You don't know which one of them will show up. You don't know if this trade will be a winner or loser, and you basically shouldn't care emotionally, right? And you should not expect of any trade to be a winner or loser. You should basically take it according to your risk and reward ratio and money management rules. But you should trade every signal. You need to identify, of course, the risk, which is how much money you are willing to risk to find out if the other traders will trade according to your position. If you will see that the other people, the other companies, the other algorithms, the other whatever, all of the other market participants, they're not in line with your trade. You are short on the head and shoulders pattern on the breakout of the neckline. All right, you are willing to risk, I don't know, some percentage of your account to see basically if the other people, if the other algorithms, if the other companies want to trade in line with you. If they don't, you basically close the position or the position hits the stop loss. You must plan your risk management for stable and consistent returns. So you cannot gamble in a way that, okay, half of the account now, and then we will see, because that's a gambling. That's a gambling which is very, very leads to very, very bad habits in the future and ends up very, very shortly in demolishing the trading account. Basically, you need to have stable and consistent returns of your trading. So this is how you should plan your risk management rules. How much you can risk per every trade. Are you looking for 2-to-1 risk to reward ratio? Are you looking to 1-to-3 or 4-to-1 or even more? You need to know that how many times you might get wrong, because there will be a sequence when, if you are playing heads, there will be only tails. 10 times in a row tail. That's it. It is possible to in the market. All right, statistically, of course. So you need to know that if there will be 10 heads instead of tails, you are going to lose this and this amount of money, and you are prepared for this, which is why because you got a nice risk management rules. So everything I wanted to show you in this presentation was about a different mind setting for the probability and for playing your odds during trading or speculating on some kind of stocks or forex currency or cryptocurrencies, whatever you trade, futures, whatever. I don't care. So that approach is way more beneficial for any of the beginner and any of the even advanced traders if he wants to understand better why something works, why some signals sometimes works better, sometimes works just a little bit, and sometimes doesn't work at all. All right? So I hope right now you understand, you grasp the concept between the randomness and the trading, and the randomness in trading, and how to make the randomness in your favor, basically in your favor of your trading strategy, in favor of your risk management rules, in favor of your general mindset and point of view about the trading and the behavior of the market, which is very, very important if you want to be profitable trader at the very end. And if you would like to contact the Global BD Trading Company, which runs a professional trading floor in the heart of the Katowice, Poland, the guys there are trading, day trading basically the US stock market. Those are the ways to contact them and book your seat for one session in Global BD Trading trading room. So I think this is plenty of ways to get in touch with the Global Bid Trading proprietary trading company. Thank you very much for listening to this these presentations. Thank you very much for participating in this meeting. I hope I see you guys next time. So thank you very much and take care. Bye bye. See you next time. Bye.